Let's walk through a question that will require us to classify different types of transactions on the cash flow statement. Watson Corporation, which uses IFRS, is using the indirect method to prepare its 2020 statement of cash flows and chooses to classify dividends paid as financing activities and interest paid as operating activities on the statement of cash flows. A list of items that may affect the statement is as follows. We have a long list of items here, and then it says match each code in the list that follows to the items above to show how each item will affect Watson's 2020 statement of cash flows. Unless stated otherwise, assume that the transaction was for cash. And we've got a few codes here. So we've got added to net income in the operating section, deducted from net income in the operating section, cash receipt in the investing section, cash payment in the investing section, cash receipt in the financing section, cash payment in the financing section, or a non-cash investing and or financing activity disclosed in the notes to the financial statements. So let's start at the top here. So an increase in accounts receivable. How will that affect our statement of cash flows? So let's put these right here. So A is an increase in accounts receivable. Well, an increase in accounts receivable means that we received less cash from our customers than we've recorded in our financial statements. So this is going to be a decrease to operating cash flow. Let's just check our codes down here. Yes, deduct. So our code is D, deduction, which makes sense. Okay, we won't worry about the codes. Let's just label them more intuitively than that. So a decrease in accounts receivable means that we collected more cash from our customers than we had in our financial statements. So this is going to be an increase in operating cash flow. See, the issue of shares. How are we going to record that? Well, this is going to actually be a cash inflow to our financing activities, because issuing shares is a financing activity because it's something that companies do to raise capital or raise cash. So D is going to be, D is depreciation expense. So what do you think? Is depreciation expense going to be, how is depreciation expense going to impact our cash flow statement? Note that they're using the indirect method here. So we're going to add back depreciation expense. So this is going to be an increase to our operating cash flow, because depreciation expense is a non-cash expense that we recognize for accounting purposes. There's no cash associated with it, so we're going to increase our operating cash flow. The sale of land at the carrying amount. Well, the sale of land is going to result in an inflow in our investing section. So this is going to be an increase to our investing cash flow, because purchasing land is usually an investment that companies make. Sale of land at a gain. Well, this is an interesting one. The sale of land at a gain is going to be, so the proceeds from the sale of land. So the proceeds from the sale of land are going to be an inflow to our investing section, investing cash flow. But we're going to add back, or we're going to deduct the gain from operating income, because the gain is an accounting concept. So we're really just interested in the proceeds from the land. So the fact that the land was sold at a gain, we would need to deduct the gain from operating income because it would have increased our net income. So we're going to take it away. And then we'll have the proceeds in the investing section. G, Payment of dividends charged to retained earnings. So dividends are dividends charged to retained earnings means that they weren't cash payments. It means that we must have issued some sort of a stock dividend. Actually, no, the dividends paid through retained earnings are going to be a cash payment in our financing section. So this is going to be a cash outflow. In financing activities. Okay, H, the purchase of land and building is going to be an outflow in our investing activities. Apparently, I'm terrible at spelling activities. Okay, I is purchase of long-term investment in bonds reported at amortized cost. So purchase of bonds is an outflow in our investing activities. Okay, and then an increase in accounts payable. So an increase in accounts payable means that we paid less to our customers than we reported in our statements. So this is going to be an inflow in operating activities. Okay. Or add to net income, I guess. Okay, decrease in accounts payable. This is going to be an outflow in operating activities, or we're really subtracting it from net income. Okay, L is going to be loan from the bank by signing a note payable. This is going to be an outflow in our financing activities. And then M, purchase of equipment by issuing a note payable. This is non-cash, disclose. We purchased the equipment with a note, not with cash. N, an increase in inventory is an outflow in operating. Because when we purchase inventory, we're using cash. An issue of bonds is going to be an inflow in the investing activities, or in our financing activities, sorry, inflow in financing activities, because we're doing that to raise cash. P, retirement of bonds, outflow from financing activities. Financing activities. Q, sale of equipment at a loss. The sale of equipment is going to be, so we're going to need to add the loss back to net income, but the sale of equipment itself is going to be a cash outflow you sold the equipment, so it's a cash inflow in our investing activities. And we're going to need to deduct loss from operating activities because it's non-cash. Okay. Our purchase of a corporation's own shares is going to be a cash outflow in our financing activities. S, the acquisition of equipment using a finance lease. This is going to be non-cash, disclose. And T, the conversion of bonds payable into common shares. This is going to be non-cash, disclose. And then U, goodwill impairment loss, same thing, non-cash, disclose. The goodwill impairment loss we're going to need to add to our operating income because it was already deducted from net income, but it's a non-cash item, so we're going to add it back. And then, and last but not least is interest paid on a self-constructed building is going to be a cash outflow. It's going to be cash outflow in investing activities. And that takes us through all of these different categorizations. So hopefully that's helpful. We're going to move pretty quickly into some more complicated cash flow examples, but this just gives us an idea of how we would classify these different types of transactions, because we need this as a building block as we move forward into preparing numeric cash flows.